Hey, it's Darius, and if you're taking a REG exam soon, you're probably wondering what's a good topic to go over for a simulation. Well, this is number one on my list, the M1 reconciliation. The exam's going to give you book income, and you've got to calculate taxable income. As far as simulations go, you can expect something like this.
What has to be added back? What needs to be subtracted? What gets ignored? Very popular question on a REG exam. So for each numbered item, we're going to pick the correct treatment. They're going to give us a drop-down list on the CPA exam, and then we're going to have to pick the correct treatment as it relates to the M1 reconciliation of book income to taxable income on the corporate tax return for a C corporation. So if they don't give you a drop-down box, they'll give you a list, and you'll have to pick from the list for each numbered item. So let's go over each item in the list before we get into the sim and say, well, when would we pick letter A? When is something expensed on the books but not deductible on the corporate tax return? And when you see the term the books, they mean the financial statements. And of course, financial statement net income is always known before taxable income is known. And that's because the SEC requires a publicly traded company to have their financial statement income reported very soon after year end. But as far as the tax return goes, IRS, you can take 3.5 months to get your tax return to IRS, right? For a calendar year C Corp, isn't the due date April 15th? Right. And you can even get an extension of that time. So that's why book income, financial statement income, is always known long before taxable income is known. So on the exam, you're going to have to do this M1 reconciliation from book income, financial statement income, to taxable income. So when will we pick letter A? When is something expensed on the books but not deductible on the tax return? Well, there's going to be a lot of those probably, because what gets expensed on the books would be estimated expenses. Under GAAP rules, most expenses are estimates. But under the tax return, that's not a deduction. The IRS doesn't allow you to estimate your way to a tax deduction. So what gets expensed on the books is a book expense for the current year. It reduces book income. But when it comes to the tax return, that estimated expense is not allowed as a tax deduction, so it has to be added back. So you'll see a lot of examples of that probably in the sim and also on the exam, where something gets expensed on the books, like bad debt expense, gets expensed on the financial statements because it's estimated, but on the tax return, you can't take a deduction for bad debt expense based on an estimate. You'd have to take an actual write-off as a deduction. And that'd be the same for warranty expense, pension expense, anything that's estimated. Okay, then when would you pick letter B? Deductible on the tax return, but not allowed on the financial statements as an expense. Well, that would be the opposite that we said for bad debt expense, where you have an actual write-off, customer declares bankruptcy, and you write it off. That's a tax deduction, but that's not allowed as a book expense. Why not? Because that book expense was already taken and matched against sales in the year of the sale. So the expense took place already, and the deduction would happen only on the tax return when it's considered a bad debt, when it's worthless, when there's a bankruptcy. What else would be letter B? Deductible on the tax return, not allowed on the books. Actual warranty costs incurred. So if a company is a manufacturer, they sell product, they estimate warranty expenses on the books, but they can't take a warranty deduction until they actually pay it. So if you see that they paid the warranty costs, then they would be, letter B would be the answer. Deductible on the tax return, not allowed on the books. Why not? Because it was already expensed on the financial statements in the year of sale. When the sale took place, they matched the warranty expense and the sale in the same period. So it's because of these two sets of rules. Financial statements has one rule for when you can expense something, and the tax return has a totally different idea of when a deduction is allowed. And we also bump into this with income. Look at letter C and D. When is it income on the tax return, but not income on the books? Well, the thing that stands out here, income on the tax return but not on the books, is where you collect cash in advance of services. Then it's taxable on the return right away because you've collected the cash. But on the financial statements, you can't call that income or you'll be cooking the books, because if you haven't earned it yet, then it's a liability, right? It's not income. So letter C would be like a landlord collecting rent in advance. That would be income on the tax return, but not on the financial statements yet. And then letter D, when is something income on the books, but not on the tax return? Well, as you earn it, let's say you've collected it in advance, as you earn it, then it's income on the books. Wouldn't be on the tax return again because you already picked it up on the tax return in the year it was collected. So again, the two sets of rules apply to income as well as they do to expenses. The IRS says it's income when you get your hands on the cash, right? But FASB says, no, it's not about the cash flow. It's about when did you earn it. Another example of letter D, income on the books but not on the tax return, would be good old municipal bond interest income, right? So if you receive income from, let's say, state of Arizona bonds, that interest income is tax-free. So it wouldn't be on the tax return, but it would be on the books. So letter D would be the answer if they showed you municipal bond interest, because then it would be income on the books, but not on the tax return. And when would it be letter E, income on the books and on the tax return? Well, that would be like U.S. savings bond interest. So interest income on U.S. savings bonds would be income on the books, and that income would also be taxable because U.S. bonds, that income is taxable, whereas municipal bonds, that income is tax-free, right? Municipal comes from the states, the cities, the townships, but U.S. savings bonds, that's a United States government obligation. That income is taxable. Why is that? Why is one taxable and one tax-free? The reason is because Congress, who makes the tax laws, decided that for the states and cities to be able to borrow money easily, the bonds that they issue should produce tax-free interest income to the investors who are buying the bonds. And this way there'll be no shortage of investors. Every time a state or a city wants to borrow money, people will line up to receive tax-free income. Whereas the U.S. government has never had to worry about a shortage of investors. Whenever they want to borrow money, there's usually enough people there to lend the money. So that interest is taxable, U.S. savings bond interest. But the municipal bonds were given a special exemption so that the city of Chicago, when they need to borrow money, could just issue bonds and there'll be enough investors. Otherwise, what would Chicago and Philadelphia have to do every time they want to borrow money? They'd have to knock on Uncle Sam's door and say, hey, it's Chicago again. We need to borrow money because there's nobody that wants to buy our bonds because we're giving off the same interest as the U.S. government. If everything's equal and it's all taxable, then the investors will bypass Chicago and they'll go right to the U.S. government and buy those bonds, because if it's all going to be taxable, then you'd rather buy the safest ones, and that would be the U.S. government bonds. What about letter F? What gets expensed on the books and deducted on the tax return? Well, any expense where the rules are the same for book and tax. And an example that they love to test would be state income tax paid by a corporation on corporate taxable income. So income tax paid to the state government by a corporation is expensed on the financials and deducted on the tax return. What about federal income tax paid by a corporation? That's expensed on the books, but federal income tax would not be deductible on the corporate federal return. But you would choose letter F, expense on the books, deduct on the tax return for state income tax. For federal income tax, what would you choose? That would be letter A. You'd expense it on the books, but you wouldn't be able to deduct it on the tax return. Let's go to G. So expensed on the books, partially deducted on the tax return. Letter G, when would you choose that? Well, that would be for like organization costs of a newly incorporated business. So you have a corporation and it's newly organized, and what do you do with those organization costs? Well, you expense them all in the first year on the financial statements. But on the tax return, there's a limit, right? You get the $5,000 immediate deduction, and then you amortize the rest. So that would be expensed on the books, partially deducted on the tax return. All right, what about letter H? When would you choose H? Not expensed on the books, nor deducted on a tax return. You know what comes to mind here? Dividends paid by a corporation. They don't get an expense on the books, nor do they get to deduct dividends paid on the tax return. What about letter I? When would you choose not includable in income for books, nor taxable on the return? Here I'm thinking stock dividends received. You get stock dividends, you're receiving shares of stock, not cash dividends now, we're talking stock dividends. Stock dividends received are not income, they're not income on the books, they're not income on the tax return. All right, what about J? What would be includable on the books? Partially taxable on the return. When would we choose letter J? Includable on the books, partially taxable on the return. What comes to mind here is cash dividends received. When there's a dividends received deduction, all that dividend is income on the books, partially taxable on the return. So let's say you're accounting for your investment under the fair value through net income method. On the books, that dividend is income. On the tax return, it's not all going to be taxed because of the dividends received deduction, but it's partially taxable, right? The whole idea of the dividends received deduction is to avoid triple taxation on that corporate dividend. Well, some of that dividend will be triple taxed. It's partially taxable, but because of the dividends received deduction, not all of it will be. So includable on the books, partially taxable on the return, cash dividends received by a company that you own less than 20% of, that you're accounting for under the fair value through net income method.
And this YouTube video is part 2 of the sim, which picks up with question 9. If you haven't seen part 1, that's okay. You could see it later on and look at numbered items 1 through 8. So we're going to pick up with number 9, section 179 deduction, $80,000. How do we handle that on the M1 reconciliation? Well, they start you with book income, and then they tell you that there's a section 179 deduction of $80,000. Was that $80,000 subtracted on the books? And the answer is no, because section 179 is only a tax deduction. So whatever book income is doesn't really matter. There was no expense taken for $80,000 because section 179 is a depreciation deduction, which gives you an immediate expense for the total amount spent for your asset. And that accelerated depreciation method known as section 179 is only a tax deduction. So it was not available as a book expense. Therefore, our answer here is that we're going to deduct this $80,000 on the tax return. It was not allowed on the books. So letter B is the correct answer. Number 10, what about costs of organizing a newly formed corporation? Well, how is that handled on the income statement? It was expensed in full, wasn't it? Yes, it was, because costs of organizing a newly formed corporation are expensed in full on an income statement. There's no capitalizing and amortizing that. But on the tax return, that same cost of organizing a newly formed corporation is capitalized, and you get to take a $5,000 immediate deduction and then the rest over 180 months. So it's a slower method on the tax return. We already expensed it in full on the books, partially deducted on the tax return this year, so the answer is G. Number 11, excess capital losses over capital gains. So the corporation must have sold maybe some stock that it held as an investment, and it lost money. Well, on the financial statements, that capital loss is expensed immediately on the financial statements. But what about on the tax return? Can a corporation deduct capital losses in excess of capital gains in the same year? No. They can only use capital losses to offset capital gains. Therefore, the excess capital loss is not deducted on the tax return, but it was expensed on the books. So A, expensed on the books, not deductible on the tax return. A is the answer. Number 12, direct bad debt write-offs. Company uses percent of receivables approach for financial reporting. Okay, so they had a direct write-off. For financial reporting, they use a percent of receivables, and that means every year they take a bad debt expense and they match it against sales. So that's how they do it on the financial statement. So when they have a direct bad debt write-off, they don't touch the income statement for that because it's already been estimated each year. For financial reporting, each year the company makes this journal entry at year end. Based on an estimate, they debit bad debt expense, the income statement, credit allowance for doubtful accounts, that's a balance sheet account. So they estimate their bad debts on the income statement every year so that when they have a direct write-off on the financial statements, there's no income statement impact at all. But what about the tax return? When there's a bad debt write-off, that's when you get a tax deduction. So the answer is the direct write-off would only impact the tax return. You'd get a deduction on the tax return, letter B, but not allowed on the books because you took the expense already each year as an estimate. So by estimating an amount each year on the income statement, in this case $10,000, if that's your estimate, then you're providing for that expense each year. So when you have a direct write-off, the income statement isn't impacted at all, but the tax return is, because on the tax return, the IRS, they don't allow you to estimate your way to a bad debt deduction. You have to have an actual loss in order to take a deduction. So that's why I really think the CPA exam will ask you something about bad debt write-offs on the REG exam, because the rules are so clearly different between financial reporting and income taxes. So direct write-off only available on the tax return. Bad debts must be estimated on the books. That's a FASB rule in order to promote matching of expenses and revenue in the same period. But the IRS doesn't care about the matching principle. Number 13, actual warranty cost incurred. So this means this is how much you spent as a manufacturer to fix broken products that have already been sold. And this is similar to number 12, where the IRS has specific rules as to when you can deduct warranty costs, and so does financial accounting. They tell you specifically when do you expense warranty expense. And you do it on the books in order to match against revenue, same as what we said for bad debts. So the actual warranty cost incurred is not the estimate. The actual warranty cost is what you spent. So that's going to be your tax deduction, but that's not allowed on the books. So look at letter B. Deductible on the tax return, not allowed on the books. If it would have said estimated warranty costs, then you would have gone with A. Expensed on the books, not deductible on the tax return. Because any estimated expenses based on GAAP rules are not deductible on the tax return. The tax return is only looking for your actual cost. What did you spend on warranty cost? That's your tax deduction. And this one clearly says actual warranty cost incurred, and that's why the answer is B. Deductible on the tax return, not allowed on the books. Now number 14, accrued pension liability. Sounds pretty fancy, right? Well, on the books it means you estimated an expense and a liability. You made a journal entry at year end. That looks like this. Debit pension expense, $10,000. Credit pension liability, $10,000. That pension expense is going to find its way onto the income statement this year, and pension liability onto the balance sheet. So this is an adjusting entry made at year end for financial reporting purposes. But what about the tax return? Does the IRS give you a tax deduction just because you estimated a pension expense? Absolutely not. So you're going to wind up taking the expense on the books, but not deducting anything this year on the tax return. And the answer is A. So I hope you're picking up the theme here. Whenever there's an estimated book expense, you don't get a tax deduction the same year. And whenever you have an actual outlay of expenditure, you spent money, that's when you get the tax deduction, but not necessarily the book expense. Number 15 now, interest received on corporate bonds. So your corporation had some excess cash, you bought some corporate bonds issued by some other corporation, and you're now receiving interest. How's that interest received handled on the books, and how is it handled on the tax return since it's from corporate bonds? And the answer is it's handled exactly the same way. It's income on the books and on the tax return, which means it's what letter here? Look at letter E. Income on the books and tax return in the same year. So you received interest on corporate bonds, that's going to be taxable on the return, and it's going to be income on the books. So this would actually not make it onto the M1 reconciliation since it's handled the same way on the books and the tax return. You'd have to tell the examiner that there'd be no impact on the M1 reconciliation if an item is handled the same way on the financial statements as it is on the tax return. Now, what if this would have said interest received on municipal bonds, state and local bonds? That'd be different because that would be income on the financial statements but not on the tax return, and it looks like then we would have letter D. Because if this would have said interest received on municipal bonds, then you would have said income on the books but not the tax return because municipal bond interest is tax-free. So this was part 2. If you didn't see part 1 yet, go back to the YouTube channel and watch part 1. You'll have numbered items 1 through 8. And then there's going to be part 3 where I'm going to finish this with 16 through 24. If you're in the I-75 course, you will find this sim in its entirety in the C Corp chapter, which is chapter 5, and you would just scroll down to lecture 17, which is the narrated sim on M1 right here.